Alright guys, welcome back. My name is Micah, and today we're going to talk about how a beginner can start investing in this market, because things are going crazy, but I think we have a great opportunity ahead of us in the next couple of months, and I just really think it's a good time to start investing if we're careful with it. So stick around to the end, and I'm sure you guys will enjoy this one. But before we start, if you could like the video, I would really appreciate it. And after you watch the video, if you think you want more content like this, please consider subscribing. Also, this is not financial advice. This is just my opinion. I'm just giving you insight on what I've learned in my short time of investing. All right, step one, which is definitely the least fun, but arguably the most important, we need to control our expenses. Because if all of our money that's coming in is just going out, how are you ever going to be able to invest? And also, how are you going to be able to pay for something when you have a real emergency come in your life? So we need that emergency fund of at least $500 and then work our way up to a few months of living expenses before we start investing. Once we have that, then we can talk about investing. Because if you don't have discipline in saving, you definitely don't have the discipline in investing. So first, build up some cash, put in your savings account, then come back to the video and we'll go through the rest of it. Before I get to the other steps, I just wanted to let you know what type of investor I am and what type of investing I'll be recommending. I am a long-term investor, which means I'm not going to be selling my high conviction investments anytime soon. I'm just going to let them mature as I age, and because I'm younger, I can take on a little bit more risk, but that just depends on everyone's age. This also means when the market is tanking and people are freaking out, that's when I'm just holding and buying more of it, because my outlook isn't for the next 6 months or even the next 3 years. I'm looking like way into the future. So I think if you have that mentality, it's a really good place to start, because in all honesty, investing isn't that hard. If you invest consistently in very safe investments over a long period of time, you'll do remarkably well. So that's kind of my mentality in how I invest, and that's what I'm going to be sharing with you guys today. So don't watch this video thinking you're going to make a ton of money in the next few years, because I'm really looking many years down the road, and that's what I'm going to try to teach here. So you just have to have that mindset to be a long-term investor. All right, so you have that savings account in place and you're getting that paycheck and you want to invest some of it, but you're not sure what to do next. So you have to pick a brokerage that is right for you. There seems like there's so many different options and you don't really know what's different about them, because like you probably heard of some of these, but you have like Charles Schwab, Vanguard, Fidelity. Those are some of the big older ones, and then you have like newer ones like Webull and Robinhood, M1 Finance, but you don't really know what the differences are between those. I'm going to talk about the two I recommend, but basically you just need something that will allow you access to mutual funds and ETFs, and also allow you to automatically invest every month, like out of your savings account, and reinvest your dividends too. But as long as it has those three things, then you're pretty much set. All right, I'm not going to go super in-depth explaining M1 Finance and Fidelity, because that'll just make the video take way too long, and I'll probably make a separate video on it anyway. But both of them are really great platforms, I think. They have no trading fees, no minimums to start an account. You can automate your investments. They have all of the asset classes you would want. There are some big differences between the two. Fidelity is much older and more established. It's one of the largest investment firms in the world. That comes with you're gonna have great customer support. You can call someone like 24/7. Whereas M1 Finance, you can only have a chat or email someone. So that's a huge difference. Another huge difference is how the design layout. M1 is much more modern and sleeker than Fidelity is. Fidelity is older and there's just a ton of information on the screen, so that can be kind of confusing. But I think both are really simple to use once you know what you're doing, and both are just really good options for a beginner investor. I would like to point out, when we're talking about brokerages, that you can have different types of accounts. So you could have your standard brokerage account or a retirement account, and that's kind of up to you to decide which one best suits you. But the retirement account, basically all you need to know is you want to have access to these funds until you're of retirement age, but it has tax benefits, whereas a standard brokerage account, you won't pay a penalty on taking your money out, but it's not going to have the same tax benefits that the retirement account has. All right, so we figured out what brokerage we're going to use, but now what are we actually going to buy within that brokerage? So this was my biggest mistake when I started investing over a year and a half ago. I was buying individual stocks that were very speculative and stocks that I didn't really know anything about. So now I try to tell everyone I can that when you start investing, don't pick individual stocks. It's way too hard and you really don't know what you are doing until you learn the fundamentals of companies. So what we should be doing is called index investing. Index funds are safe, require little work, and provide great results. An index fund is composed of hundreds of companies, so when you buy that fund, you're buying all little pieces of every single one of those companies. This diversifies your portfolio and alleviates risk. So rather than betting on an individual stock, you're really betting on the American economy along with the world economy to do well over the next couple of decades, because if that happens, you're pretty much guaranteed good results over a long period of time. You buy index funds through ETFs, which are called exchange traded funds, or mutual funds. They act a little bit different, but basically they're the same thing. In each of them, you can buy indexes through. Okay, so just because you see an ETF or a mutual fund doesn't mean it's an index fund. Okay, so the expense ratio is actually part of how investment firms make money. So when people put all of their assets in these investment firms like Fidelity or Charles Schwab or Vanguard, they need to pay their employees and actually, it's a business, make money. So a tiny piece is called the expense ratio. You'll actually pay to the people that are running the account, that are running the infrastructure and everything to do with your investment. But then with an actively managed fund, you're paying for that along with people actually buying and selling the securities that you own. Because when you buy through an index fund, you're basically buying the stock market averages as it goes up. But then you could also pay someone to try to outperform that market. That's the idea of an actively managed fund. And so sometimes you'll pay 7 to 10 times higher of a fee for an actively managed account in hopes that you're going to beat that market average. There is a huge debate that's been going on for decades of whether actively managed funds actually outperform the market, but to keep things simple, I suggest that we just go with index funds. All right, so the next question is, which index funds do we actually buy? So the point of an index fund is to be able to invest in different companies, but to alleviate much of the risk of buying individual stocks. We alleviate this risk by properly diversifying our portfolio. This means we invest in different market caps, different sectors, countries, and asset classes. So market cap refers to market capitalization, or in other words, how big the company is. So we need to be investing in small companies, mid-sized companies, and the large companies. And when I say different sectors, I mean different industries of the economy. So we're going to be investing in financials and healthcare, technology, utilities, energy, things like that. We also want companies in several countries because even though most of the largest companies in the world are American companies, we still want exposure to those international funds to help diversify the portfolio. And when I say different asset classes, I'm specifically referring to real estate. I think it's a good idea to further diversify your portfolio with a small allocation towards real estate. Real estate is also seen as a good hedge against inflation. All of these factors just help to alleviate risk while still getting us adequate returns. If you're thinking to yourself, well, I'm younger and maybe I want to take on more risk, there are a few things we can do to adjust the portfolio towards a person who is more willing to take more risk. So for me personally, I would consider myself to have a high risk tolerance. So I actually increase the amount of smaller cap companies I own, as well as emerging market companies. So basically, instead of buying a ton of the more stable big companies. I buy more of the smaller companies, and that's one way to give yourself more risk if you are in that younger age group. This portfolio is on the aggressive side. If you were older or in the retirement age, you definitely wouldn't want all of your money tied up into stocks, because this is all stocks besides a little bit of real estate. You'd want to look more into strictly dividend stocks as well as bonds. But for me, I'd rather have more of my portfolio with the smaller cap companies, because I think over time I will adjust into the more stable dividend stocks and bonds. But for me right now, I want more risk and I'm seeking a bigger return. All right, so another important question is, when are we going to buy? There's probably one thing harder than picking the right stocks, and it's timing when to buy and when to sell. Because no one knows what the market is going to do, I think it's best to just consistently buy month by month so you can dollar cost average into your positions. This also takes any of the work out of it for you, because you can just set up an automatic buy order on M1 Finance and Fidelity. So every month on a scheduled day, it will buy this amount, and then you can allocate it to exactly what you want to buy. And I'll show you how to do that in a second. But in the end, all you really need to know is buy consistently over a long period of time, and you will do well. All right, so now I'm going to go into M1 Finance and Fidelity, and I'm going to show you some of the funds I was talking about. I'll also show you how you set up the automatic buy orders and to have your dividends automatically reinvested. All right, guys, this is M1 Finance, and here I have a 3-fund portfolio. I have the Vanguard Total Stock Market, Vanguard Total International Stock Market, and then the Vanguard Real Estate ETF. And I want to show you that you don't need very many funds to be properly diversified. Like, these 3 funds will do you fine. And we'll go over to Morningstar. They do pretty good analysis on it. One thing you'll notice about M1 Finance, you can't actually find that much information as far as like financials and different like stats about different mutual funds, ETFs, or stocks on here. They're a great platform, but I go elsewhere to do any research. So Morningstar is a site I highly recommend, especially for ETFs and mutual funds. And this is VTI, the total stock market. We can see that right here we have value and growth, which is great. And then we have small cap, mid cap, large cap. And then if we go down here, we have, we're representing all of the sectors. But then if we go to region, it's all North America, and it's actually just all United States. So that's why we have this other fund called Total International Stock Market, VXUS. So then same thing up here. We got small, mid cap, large cap. And then if we go down here, you can see that it is spread out. It has every country, not every country, but it doesn't have America on there. It's got Japan and Britain and China and Canada. So that is really good for being properly diversified. And then I put in that small one for the real estate. Those are called, you invest in real estate investment trusts. I think this thing has like 137 of them. So those will be across many different sectors. And it's just a really good way to diversify further into a different sector. And some people, when they think of a 3-fund portfolio, they probably think of like a bond mutual fund or ETF in there too. I don't think that's a great idea for me because I'm young. I don't think bonds are really gonna help me out that much. Later in life, bonds will become more important to me as I need a safer investment. But right now, I choose a little bit higher risk, so I don't really worry about including bonds in my portfolio. And then I also made this second one. This one has 5 funds in it, and it's a little bit different. So this is the S&P 500. So you have 500 of the largest companies. They're mostly American, but then we have this international fund like before, and then I put a small cap, mid cap, and the real estate in there. So if you wanted to be more risk adverse, you could increase your percentage to small cap. That's why I kind of included that, because if you just have the total stock market like in the other one, you can't really dial in on just like small caps. So then I just put the small cap and the mid cap in this one. And if you wanted to edit this, you go to edit, and then you can adjust the percentages. But also if you wanted to add something or remove something, you can go in here, and this is all the stocks. But then if we go over here, we have funds, and you can see This is assets under management. So if you click this, those funds have the most funds within them, I guess is the right way to say it. And we can see over here we have expense ratios, like I was talking about, in 0.03, 0.09, 0.07. Those are all super low. When we have like actively managed funds, they're like 0.75 to a percent or even higher, that you're like paying someone to manage that for you. So that's why these are considered index funds. And also something we don't have on Fidelity, I clicked over here, I went from funds to expert pies, and you can click around on these, but these are just other ideas. They'll be somewhat similar to what I showed you, but it'll just click on one. This one is, if you go down here, this is 90% stocks and 10% bonds. So it's just two funds. So we have Vanguard Total World Stock ETF and then Total Bond ETF. So there's just a lot of options. And like if you go on this other one, it will show you like from ultra conservative to ultra aggressive. So you can just get a good feel of like what is being, what is taking on more risk and what is taking on less risk by these expert pies. And then they have like retirement things. So there's just a lot of cool resources on M1 Finance that you can look at. All right, so if you were going to like automate your buy orders on M1 Finance, you would go to transfers and then rules. I already have one here. I don't think you would, but then you'd go on it and you could just edit, and we'll look at this. So you'll just ask you for like your bank account and then to which account you'd be going to, the amount, and then you can just like schedule it for however you want. And also if you win your dividends, to automatically reinvest, because all three of these are going to give you dividends. Those dividends show up right here in your cash balance, and then I think once it's $25 in there, it will automatically buy and split it between your allocations. So that's super cool too. All right, so that was M1 Finance, and I think it's a great option for anyone that's new to investing. I've been using it for over a year now, and I really like the platform. But I'll show you what Fidelity looks like. It's a little bit more confusing at first. It has a lot more data, and you can do a little bit more with it, but both are really good. All right, so I'm on Fidelity's website here. I'll go to the brokerage in a second, but I just wanted to point out Fidelity is something that no other investment firm that I know of has. It's right over here. These zero expense ratio index funds, which I was talking about the expense ratios a few times now. There, you pay no fee to use these indexes, which basically means like Fidelity's losing money on this, but they're just trying to gain new customers. So they think this is a good idea. So I'm invested in one of these, but it's really cool that you're not even paying any type of little fee. And also you can see like Fidelity compares super good to Schwab and Vanguard. Its fees are like just amazing compared to like everything. So I really like Fidelity for that reason. But then let's go over to, I'll show you this. This is the summary page first. So it's kind of confusing and there's a lot of information going on. You have some like news and like market movers and your positions and just like a bunch of information. Your actual position page would look like this. So it's just a lot going on. But if we wanted to look at like the mutual funds like we were looking at M1 Finance, we'd go up here to investment products, click on mutual funds, and then you're going to click explore our fund offering, and then click index. So this will show you the index funds like we were looking at on M1, and there's a lot more options. They're all like right here. And it's a little bit confusing, but you just kind of have to read what you're looking at. And so if we're talking about, this is one of the zero expense ratio funds, total market, that'd be like the VTI one they were looking at. And then we can see like small cap index, mid cap index, but they also have like a few different kinds. So you can see like small cap value here, small cap growth, and then just a small cap index. This kind of is a risk preference, but also if you're more of a value investor or maybe you're a little bit older, you would maybe want more stable value stocks. I choose the growth or even just like a regular small cap index fund, but it's kind of a preference thing. And then you can see like the international fund. So this is also a zero expense ratio one right here. So that's pretty cool. And if you actually click on stuff, it shows you way more information than M1 would. So this is kind of comparable to Morningstar, but it shows you a lot of data, and then without clicking on like composition, so you can see what type, like this is large cap, and then the sectors and its holdings. So it just shows you a lot of information over there. So it's a little bit confusing. So these are considered mutual funds, and I won't go into like the details of the differences, but think basically that these Fidelity funds are exactly the same as the Vanguard ETFs that M1 Finance has, because M1 Finance works with ETFs. Fidelity also has ETFs, but like I prefer using the mutual funds. And if you wanted the exact same portfolio that we were looking at before, here you have that real estate index fund that I had like 10% of the allocation towards, and then we have the Fidelity Total International Index Fund, and also somewhere in here is the total, there it is, Total Market Index Fund right there. So, and then you can click on those and get all of the information, but everything you need is right in here. You just kind of have to read through it, and then you can look at it, look at the data, and Fidelity just does a great job of providing you with all of that data. All right, so if you want to set up automatic investments, you go to Account Features, and then you're going to click Payments and Transfers, Automatic Transfers and Investments, and then this page will pop up. So this is two things are happening here. First, you have to transfer money from your bank account to your core position. That's this first line here. And then once it's in the account, you have to set up a second transfer from the core position to the mutual funds you actually want to buy. All right, and lastly, if you wanted to have your dividends being reinvested, you actually have a few options with this, which is pretty cool. You go to Account Features, and then you go to Brokerage and Trading. The first one is Dividends and Capital Gains. You'll click on that, and then you'll see a list of all of your different securities. And then here you can click Update, and it'll allow you to reinvest the security, deposit to your core account, or actually go to a different mutual fund. So I have them all being reinvested in security. You could put them in your core account if you want, but like then you have to go back and like use that money. So I think it's just a good idea to have it automatically reinvest, and it's just a pretty cool feature. All right, so that was M1 Finance and Fidelity. Both are great options. They have their differences. Obviously, they look very different. Fidelity's more outdated. And another thing that I did not mention, with M1 Finance, if you ever time a buy, you only get one trading window in the morning, right when the market opens up, it would execute a trade. Or if you paid for the M1 Plus version, you could get another trading window at like 2 p.m. But with Fidelity, if you were buying an individual stock or ETFs, you could trade them throughout the day. M1 does not give you that option, so that's like an important distinction that I forgot to mention earlier. Okay, I'm gonna wrap this video up with a retirement calculator that will show you what type of gains you could expect based on how old you are, how much you're contributing, and what type of return you think you could get. So I'll show you that, and it's actually like really cool to see what like consistently investing can get you down the road. All right, so here we have a Roth IRA calculator, and when I talked about retirement accounts, a Roth IRA is one type of retirement account you could choose. I think it's best, especially for a younger person, but I won't go into all the specifics between a Roth IRA and an IRA. They're both tax sheltered to some extent, but this is going to compare it to a taxable brokerage account. So it'll really show you why many people suggest maxing out your retirement account every year before you even put money into a brokerage account, because of all of the gains you would lose if you had to pay taxes on it. So we'll just plug in some information here, and I'll do it off of me personally, but feel free to try this. I'll put a link in the description so you can try it, but there's plenty of these online. They're not too hard to find. So if I have about 6,000 in there and I want to contribute 6,000 every year, 20, retire at 60. I chose expected rate of return at 9% because the stock market on average in its lifetime does a little bit over 9%. So I felt like 9% was a good good target there. And then it asks you for your marginal tax rate here. This is so it can calculate the brokerage account, the taxable brokerage account, because this won't come into effect if you have a Roth IRA, and it shows you a little chart here. I just pick something in the middle, so I just chose 24%. That means I'd have contribute $240,000 from now until I'm 60. And then we can see right here that would equal $2,398,208 if I got a 9% return. And you never know if you're going to be guaranteed that 9%. Some years you'll do really good, some years you'll be way negative, but in general you should go up. And you can see how much you lose when you have to pay taxes on that, because you're going to pay a huge tax once you sell everything. So Roth IRA is just super cool. I think that graph really shows you that anyone can retire a millionaire. It's not that hard. Like $500 a month could give you $2.4 million by the time you're 60. It's just crazy to think about. And it's also crazy to think about that your investment of $240,000 could equal $2.4 million because of compounding interest. So basically, if you invested $100 and then it grew at 10%, next year you're going to have 110, but then the year after that you're going to get 10% of 110. So you're making $11 instead of $10. And as you keep adding to it, it's not a linear line that goes up. It's an exponential line that just keeps on going, and just like a really cool effect. All right, guys, I did my best to explain all of that. Let me know what areas were confusing, or maybe other things you still want to know in the comment sections, and I'll try to do more videos on specific parts of that. But I just wanted a general video of how to start investing, because the market has really been heading lower this year in the last couple of months. So it's just like a great opportunity to start investing. One final piece of advice I would like to tell you is that you need the discipline not to sell when things are going badly. So I don't know if you saw my account balances, but the last couple of weeks, the stock market's been really bad, and it was at like all-time highs not that long ago. So it's okay for a correction to occur, but there's just a lot going on in the economy right now that I won't really get into. But you just need to be consistent with it and keep buying even when everyone's panicking, because so many people are just like panic selling and losing so much money. So really keep focused and just keep buying the dip, because good days will happen and you have to be looking far out into the future. I wanted to say a Warren Buffett quote that goes along with this idea perfectly. He said, "Investors should be fearful when others are greedy, and greedy when others are fearful." So when the market's getting to all-time highs and people keep buying stocks even when things are getting overvalued, that's when you need to be concerned. But on the other end of that, when stocks are selling off super hard and people are losing their minds and selling everything because they think stocks are always going down, that's when you should be buying. That's when you'll be making money, and you just have to keep a level head and you'll be fine. Just keep investing. All right, guys, that is it. Thank you for watching this video. I really hope you have a great day, and I will see you guys in the next one.